Last year, HDFC Bank collected over 1,112 crore rupees just from minimum balance penalties. Not from loans, not from investments, from people like you who simply forgot to keep enough money in their own account. Stop and think about that for a moment. You worked the entire month, your salary came in, and the bank still found a way to take money from you. That is not a fee. That is a system. And today, I am going to show you exactly how it works. Let's start with minimum balance. And I want you to pay close attention here because most salaried people get this completely wrong. When you join a company, your salary account has no minimum balance requirement. That is true. As long as your employer has a corporate tie-up with the bank, your account is classified as a salary account and the minimum balance rule is waived. But here is what the bank does not tell you clearly. The definition of minimum balance is not your closing balance at the end of the month. Banks calculate what is called the average monthly balance, AMB. They take your daily closing balance for every single day of the month, add them all up, and divide by the number of days. So even if your salary of 60,000 rupees hits on the 1st and you spend 55,000 by the 20th, your average monthly balance could fall below the required threshold for that month. And the penalty? It is not a flat 500 rupees. It is tiered. The more you fall short, the higher the charge. And it is applied every single month, silently, without any notification that feels urgent enough to act on. HDFC, ICICI, Axis, they all do this. Every single rupee counts for them. The cruelest irony is this. The people who can least afford to keep high balances are the ones paying the most in penalties. Now let's talk about something that genuinely shocks people when they find out. Most do not even know it happened to them. When you leave a job, or when you are between jobs, your salary credits stop. RBI guidelines state that if a salary account does not receive a salary credit for 3 consecutive months, the bank is required to convert it into a regular savings account. No dramatic notification. No email with a subject line that says your account type has changed. Just a quiet reclassification deep inside their system. And what changes when that happens? Everything. The minimum balance requirement activates immediately. The charges that were waived suddenly apply. Your account, which you believed was exactly the same account, is now operating under completely different rules. You did nothing wrong. You did not sign anything new. But your cost structure just changed completely. I have seen this happen to people who took a 3-month career break, people between jobs, even people who switched to freelancing. They come back to their old account, start using it casually, and suddenly find deductions they cannot explain. That is not a system error. That is deliberate policy. Now, let us talk about the small numbers, because small numbers repeated 12 times a year add up to real money. Debit card annual fee. Anywhere from 150 rupees to 750 rupees, depending on your card type. Auto-debited once a year. Do you remember approving that charge? You did. Buried inside the account opening form, in the fine print that nobody reads on the day they join a new job. SMS alert charges. Most banks charge 15 to 25 rupees per quarter for transaction alerts. That is 60 to 100 rupees per year for messages your bank sends you anyway because they are legally required to. You are paying for a service that exists primarily for the bank's own compliance. NEFT and IMPS charges. Some banks still charge 2.5 to 5 rupees per transaction beyond a free monthly limit. If you are making 15 to 20 transfers a month, do that math yourself. And then there are the ones nobody talks about. Checkbook issuance fees, cash deposit charges beyond a certain number of transactions per month, and inactivity fees on accounts that have not been used for over a year. None of this is illegal. It is all technically disclosed in a 48-page document given to you at account opening, printed in a font size that feels deliberately designed to discourage reading. That is not transparency. That is compliance theater. Now the final point. And this one should make you genuinely pause. The moment your employer transfers your salary into your account, That money sits with the bank. You will spend it over the next 10 to 20 days. Rent, groceries, EMIs, daily expenses. But during those days, that money is in the bank's hands. Banks use this pooled float, millions of salary accounts receiving credits on the same few dates every month, to earn overnight interest, to meet their daily lending requirements, to park in short-term instruments. With the RBI repo rate where it is today, that money earns somewhere between 6 and 6.5% annualized, even just sitting overnight. You receive zero of that. Your savings account pays you 2.7 to 3.5% per annum on your balance, and only if your balance qualifies. The difference between what the bank earns on your money and what they pay you back is their margin. Multiply that across crores of salary accounts every single month, year after year. This is not a conspiracy. It is a business model, and the only way to protect yourself from any business model is to first understand exactly how it works. Here is what I want you to do right now. Open your bank app or net banking portal. Pull up your last 6 months of account statements. Look for 4 specific things: any minimum balance penalties, any annual or quarterly service charges, any debit card or SMS alert fees, and check whether your account is still classified as a salary account or has been quietly converted to a savings account without your knowledge. Write in the comments below what you find. Not to vent, but because when 500 people report the same charge from the same bank, that becomes data. And data is harder to ignore than complaints. Subscribe to this channel, because every Saturday we open one more door. Same calm, same proof. No drama.